You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, let's start by looking at what we did last week. Last week, we talked about selling a put to buy stock in Ford. Now, Ford and a lot of the car companies were having some problems basically with supply overall because of the situation with the chips. A small little ship got stuck in a even smaller river and created some supply issues. And Ford had to react to it, and all the other car companies were having some issues with it. So they got beat up a little bit on it, but obviously the supply chain will probably come back in line eventually here. So that was kind of our play. Ford was down last week, and we decided, well, if it goes down any more, we'd be happy to buy some shares in Ford overall. And Ford has made some traction in the EV space, just like GM. A lot of these companies are coming around to the fact that they do need to make some investments. And Ford had invested in Ravinia, which is a company that actually is making some EV vans for Amazon that are supposed to be coming out next year. And so they're sticking their toe in the water, seeing exactly where they want to play out. But all along, they're still doing well in their space, making their normal vehicles, especially their trucks. So we decided, well, if it came back down a little bit, we'd be willing to buy 100 shares of stock. So we sold last week. We sold the 12 strike put with the stock right around 1230-ish. All right. So overall, Ford went up. So it came down a little bit, went up a little bit. And right now we're taping Options Playbook Radio, and it is a Wednesday. The markets are closed. It is April 7th. That put that we sold, now, you can say, well, was it a good trade or was it a bad trade? Bottom line is that put that we sold for 32 cents is now trading on the asking price for 9 cents. So we are profitable on the trade, but ideally we would like Ford to come down a little bit more and actually have that opportunity to buy it. The expiration on the put that we sold was April 16th, so it's still got a few days to live. So what I would maybe think about doing if I still wanted the Ford stock, so it's all about your approach to this underlying, is maybe roll up a little bit. I roll it up to the 13 strike. If I really wanted the stock, it got beaten up. It didn't continue down lower, even though it's had a real good run up since the beginning of the year. And I would think to stay in the same expiration, and I'm going to do something a little different here that I don't talk about a lot on Options Playbook Radio, but I'm going to sell an in-the-money put, which is basically a surrogate to a covered call. So we're going to make approximately 20 cents on the put that we sold last week. And if I were to roll it, I would be buying to close that April 16th 12 strike put and then selling to open the 13 strike put. Now, Ford right now is at 1273. It was down 19 cents on today's trading. So we're selling something that is 27 cents in the money. Now, that option contract, I want to pay a lot of attention to what it's actually trading for, because I don't want to sell that put and just get the intrinsic value for it, basically the 27 cents. But right now, we're seeing it trading at 46 cents on the bid, 49 cents on the ask overall. So I wouldn't mind maybe rolling this if I really wanted to buy the stock. I missed out on the opportunity. You could say, last week, I should have just bought the stock as opposed to selling the put because the market didn't come down. So now I'm going to attempt to make sure I buy the stock by selling an in-the-money option contract. And I can roll that and bring in a net credit to the account at the midpoint of 40 cents. So the trade would be, my adjusting trade would be, once again, buying to close the April 16 12 strike put, and at the same time selling to open that April 16 13 strike put. And I want to do this all for a net credit to my account of about 40 cents. Now, no guarantee of midpoint fills. And as always on Options Playbook Radio, everything we talk about is a learning experience. It's not meant to be a recommendation. But I just thought it would be an opportunity to talk a little bit about selling in the money puts if it's a stock that you really like. And if you're going to do that, you just want to make sure that you're receiving enough time premium to make it worth your while to do that. Now, it could so happen that by April 16th that Ford's above 13 and you missed out on that opportunity again to actually buy the underlying stock. But at that point in time, you'd be up 60 cents on your requirement, which would mean in this point in time, you'd have to be able to buy 100 shares of stock at $13 or $1,300. So I'm making $60 on that. So now I'm making a decent amount on that trade by doing it. But my goal here by rolling to the in the money put this time is that I really want to buy that underlying. And if you don't, then this isn't the trade that you want to do. You just let that option expire or close it out right now for 9 cents and get out of the trade and move on. Speaking about getting out of the trade and move on, let's move on here on Options Playbook Radio. So to keep with this theme on Ford and the fact that a lot of the bigger car companies, well, I don't necessarily mean bigger, a lot of the car companies are making headways in the EV space, let's talk about Tesla. Tesla's had a little bit of a tough time of it. As a matter of fact, Ford has outperformed Tesla on a fairly big scale since the beginning of the year. And Tesla today, we see it trading at $670.97. It's down $20.65 today. Now, Tesla last week actually had some decent news on deliveries overall. They're not going to be announcing earnings until the end of April, beginning of May. So we do kind of want to avoid that scenario here. The big news about deliveries came out last week, so that was a big news event. And the next big one would be earnings overall. Stock is down. It ran up a little bit on the news. Now it's kind of given some of that back once again. So if I'm thinking about Tesla, I think about implied volatility in general when I'm looking at that stock. And right now, we have the VIX trading right around 18%. It's down quite a bit, but it's still high relative to what it's been over the last 5 years historically since the pandemic announcement and the big downturn in March last year. We still have a lot of companies trading at high volatilities. Tesla has kind of settled down a little bit since it's been introduced to the S&P 500 index. But this week, I'm going to look at doing a short spread, but I'm going to do it with a little twist to it. All right. Right now, I'm going to still look at that April 16th expiration. It's 9 days away. And I am going, and if I was thinking about trying to capture some of that volatility premium, I would look to maybe sell the 720 strike put, and at the same time buy the 730 strike put. Okay. That would just be a short call spread, and that would bring in a decent amount of premium. Now, we're not way out of the money on that trade, but we are a good bit out of the money. In other words, we're less than a standard deviation away. But I can do this 10-point wide spread right now for a net credit. Remember, the markets are closed at the midpoint of 170. So $170 on a $1,000 margin requirement, and we have 9 days remaining to that expiration. Now, 170 minus 1,000 means we obviously have a lot more risk than we do reward. That means $830 is our risk overall if we were to do that trade. With vols so high and premiums where they are, and in particular, we're talking about an expensive stock, which adds some premium. And on top of it, we got some decent volatility, which is obviously going to add some premium to our out-of-the-money option contracts that we're dealing with. I really don't feel comfortable just selling the short spread. And I'm going to build this as an alternative to the short spread. Now, a lot of people will listen to my strategy when we get all said and done here and say, well, that's an alternative to a butterfly. Well, no, it's not. It's going to be an alternative to a short call spread. We're going to do a skip strike butterfly. Basically, we're going to embed our hedge into our short spread. And this is a totally different way to talk about it, but I've mentioned it a few times since volatilities have been so high over the last year on not only individual stocks, but also even on the indexes, that this is an interesting alternative to just selling short call spreads and short put spreads if you're bullish and trying to collect some premium. So in this instance, keep this in mind. The initial trade, which isn't the official paper trade for this week, is sell the 720 strike call, buy the 730 strike call, being a little bearish on Tesla overall for the next 9 days. Midpoint right now is 170, 10 points wide, bringing in $1.70. Okay, so if that was our goal to keep the stock under that 720 level, how could we do it with a skip strike butterfly? And inside the options playbook, I highlight it as a skip strike butterfly. It's also known as a modified or a broken wing butterfly, which makes no sense to me whatsoever, those names, because it doesn't describe what you're doing. If you actually are putting on one of these trades, a skip strike means that we're actually going to skip the normal strike and go a little further out in time, which basically embeds the credit spread that we were just talking about inside of our butterfly. So how would that work? Okay, so the 720 strike is going to go away. We're not even going to trade that at all. We're going to end up selling the 710 strike and buying the 700 strike. So the official paper trade for this week is an alternative to a short call spread, and it's going to be a skip strike butterfly with calls on Tesla. And our goal is to bring in a decent premium and hopefully capture that premium. We're hoping that Tesla will actually go down. Our best case scenario is that it would go up a little bit, but ideally we're doing this thinking the market might go down and we can capture that premium. Okay, so the official paper trade on April 7th today, the markets are closed. Tesla closed at $670.97, down $20.65. We are going to buy the April 16th expiration 730 call. We're going to skip the 720 and then sell 2 of the 710 calls and then buy 1 of the 700 calls. Now, the risk stays the same, just an FYI. The margin requirement can be different at some brokerage firms, but the risk is going to be that short spread that we embedded inside our butterfly, which is 10 points wide or $1,000. Now, the downside is that we're going to receive a little bit less credit. In this instance, I'm seeing that skip strike butterfly trade at a net credit of $1.23. We'll call it $1.20 to make the math simple. So bottom line is we're receiving 50 cents less for putting this trade on, we still want the stock to stay below 720. That's where our risk really starts to kick in. And we have embedded some protection in case the marketplace goes towards our short strike. And what have we embedded? We embedded a long call spread that is also 10 points wide that would benefit us if the stock went towards 710, our short strike, and just hung out there. So the entire trade brings in 50 cents less, but we have potential to make another $1,000 or another 10 points on this trade if the market were to go on up and stop at close to that expiration date at $7.10. Now, it's very important to me that I can bring in a decent credit by doing this trade. And it's also very important to me that I can do it in a short time frame. Because as we've talked about a lot with butterflies in particular, it's hard to get close to the maximum on a butterfly on an expensive underlying, not to mention one that has a 58% implied volatility on the at-the-money option contracts. So because of that, I want to do it as short term as possible. As a matter of fact, I might even wait on this trade and look to do the Tesla trade on Monday and basically have 1 week's worth of trading. Now, the whole strikes would change, everything would change overall, but we tape Options Playbook Radio usually on Wednesdays after the close, so we're going to deal with a 9-day option contract. Now, Tesla has enough premium in it that a 5-day contract might be feasible, and you still might get a decent premium, basically looking at the same approximate amount out of the money if things all are relative. But right now, this is going to be the paper trade for the week. And what we would ideally like to happen, our goal here is we're really getting short Tesla. We're getting short Tesla by bringing in a net credit to our account, trying to bring in some premium from that volatility. So if we were in the short spread, we just want the market to go down, and that would be the best case scenario. Now, in this scenario, if you want the best case scenario would be that Tesla just kind of hung out right here over the weekend, hanging out right where it's closed today, which is about 671. And then on Monday, slowly drift up towards that 710 strike and ideally finish somewhere between 700 and 710. Now, if it goes beyond 710, you're still okay. All the way up to that 720 level, that's where our risk really starts to kick in. But if that happened, I might actually make more than the net credit received on this entire trade, which is definitely not possible if we just did the short spread overall. So if I'm doing this trade, I'm setting an alert at 700. If the market starts coming hard against me, let's say tomorrow morning I wake up and Tesla's at 710, my short strike of my butterfly, I got no time decay, I got nothing, I'm just going to close it out. I would ideally be down on the trade, just like I would be on a short spread, but I don't want that maximum loss to kick in. So if that were the case, I would take my comeuppance and I would just close out the trade and I would move on. All right, so that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. It's very simple. At Brian Overby is my handle. Thanks for listening. We'll be back the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.